Okay, this is Mike Durr, Kingwood Mortgage Guy, and this is the second of a series of online webinars that I'm doing that hopefully will make some sense for people in this area. And what we're going to do is tonight we're going to talk about raising credit score, and the premise of this is 45 points in 45 days. Now, a lot of people don't really understand how this works, and it's my job to kind of give you insight into what works and what doesn't, and hopefully give you some optimism that the process of doing this is really just a matter of math and function, and it actually is just knowing the rules. So when you know the rules, it makes an amazing difference. So first off, we're going to do a little preliminary stuff is what is credit scoring? And it's the use of a statistical risk assessment model which uses Consumer Reporting Agency information to significantly increase the level of the predictive power to determine good payers from bad payers. So this is a tool that is used by the credit reporting agencies and creditors to determine if they should extend credit. And it's something that they can do. If they can make quick decisions based on scoring as opposed to having to analyze everybody's credit report. So where the scores come from, well, I always like to share this because this is really, and when I was first starting in the mortgage industry, how we did it. And what we'd do is we'd pull a credit report and we would look at how they paid their mortgage or how they paid their rent. And to us, that was really an important factor. And we would measure it, whether they paid, and if there were any 30 days late, any 60-day lates, or any 90 days late. And of course, the mortgage to us, or the rent, was the most important. The second most important creditor were installment debts. And these are secured credit type debts, like a car loan. If you don't pay your car loan, guess what? They come and take it back, right? If you didn't pay for your house, we came and took it back. The third and the least of the what we considered worthy were credit cards, unsecured credit. And for whatever reason, our thinking at the time was that they were less important factors on whether someone would pay their house payment or not. And then that may be the case, to be honest with you. But we, the weight that we gave to the credit cards was much less than obviously a rent or housing payment and or even an installment payment. Now that is completely flipped around, and how you pay your credit card is now pretty darn important. So that is the premise of what we're going to see, and it's a big part of how you can affect your scores. So with credit cards, they're unsecured. That means that they didn't have anything that they could take back. Their biggest fear was that the borrower would file bankruptcy, because in a bankruptcy, they really kind of wipe the unsecured creditors off the books without any compensation in most cases. They also found that people who filed bankruptcy had a tendency to use all of their credit capacity just before filing their bankruptcy. Now, so what that means is, I think I have a optimistic view of how people handled their credit and handle credit today. But if you had a credit card and you were trying to stave off bankruptcy, then you used what credit that you had to survive until you could turn things around. And I'm convinced that people weren't actually trying to gig the credit card company. Some were, maybe, some were mad, but I don't think most of them were. I think that they were just trying to delay what was turned out to be an inevitable factor. So today, one of the things that the algorithm measures is how much of your capacity have you used. So if you have credit cards and you have a $5,000 limit, then they're very interested in how much of that capacity you've used. And obviously, the higher the capacity that you've used, the more nervous that the credit scoring algorithm or the creditors get, and the algorithm does not reward high credit card balances. It rewards low credit card balances. So that's going to be a key factor, and that's a little insight into what we're going to be talking about. So scores are dynamic. It's really, when you get a score, it's a snapshot of a consumer's credit profile at a particular point in time that a credit report is obtained from the credit reporting agencies. Credit scores are not stored in the consumer's credit file. And just because you have a 460, you could have a 640 next week. It just depends on what fits, what data is put into the algorithms, and it just pops out a score. And of course, this is something, the fact that they're dynamic means that they can change. And I think that that's a very positive thing. So the score represents, a summation of the risk of repayment of debt by a consumer based on the credit reporting agency's credit profile for that consumer, as it is ranked against the profiles of all the other consumers with credit reported and stored within the specific credit reporting agency's files. So when you get a credit score, it's being measured against everybody else's credit scores. And if you're on the low side of it, then guess what? You just need to buck up, man. You need to get it together. No, I'm teasing you. It's like high school, it's a bell curve. Now, a lot of people ask this question: why are each of the bureau scores different? Why don't they all agree? Well, and then the next one, which score is used? Different industries use different models, and they weight them. So just like I was telling you, as a mortgage person, we were very concerned with how somebody paid their rent payment. And of course, if their housing payment was not paid. Well, the same thing, even though if I was an automobile lender, if I lent money on automobiles, what would they be concerned about? Well, they'd want to see how you paid your car note, and they'd be less interested in how you paid your house payment, right? And in both cases, they probably wouldn't care very much about how you paid your credit, to a degree, I guess. But what the point is that almost every different industry has priorities and biases. And so that's one of the reasons. And then you've got three competing agencies. You've got Experian, you've got Equifax, and you've got TransUnion. Each one of these is a for-profit company that is trying to sell their membership to creditors that issue credit. And of course, obviously, they do that for profit, and they try to work with the creditors as to what they're looking for. So they're rarely going to be the same. They're going to be similar, but they're not going to be the same. So that's my preamble. And now what we're talking about is we're talking about raising your credit score. Well, 100 points in 45 days, I've seen it happen. It's more likely that we're going to raise your credit score 40 to 45 points in 45 days, but it really just depends on what's on your credit. But there are ways to do it. So my name is Mike Durr. I am the Kingwood Mortgage Guy, and let's get going. So what makes up a credit score? The first thing is, and this makes the most sense, I mean, anybody, if you ask anybody, how do you get a credit score? Well, the first thing they'd say is the payment history, how you've paid your bills in the past. That just makes a lot of sense. And you can see that it represents 35% of your credit score. And I honestly, if I was calculating the first time, if somebody asked me what percentage the payment history represented, I would probably say a higher percentage. Now, the next one is the balances carried. And you see there, it says 30%. So we're going to come back to that. Credit history, so how you've done over time, is a factor. It's not your payment history over time, it's just your credit history, how you've handled credit over the last years or months or however long you've had credit. Then they have, for 10%, a mix of accounts. And if it's heavy with credit cards, then that would probably be something that they wouldn't like so much. But if it was heavy with no credit cards, or it was just mortgage and installment debts, then that could affect you too. So what they want is, they want a mortgage, they want an installment, and they want a few credit cards. That would be a proper positive mix where you might get the maximum number of points. And then according to this, it says inquiries. And inquiries, I guess I answer questions about inquiries, seems like every day. And the first thing I'm going to tell you is that inquiries do and can cause you a dip in your points, in your score, but it's rare. And usually I find, and I'm not reading this from any textbook or anything like that, I find that the people that have newer credit, it might be younger people or they're new to credit, because they don't have a depth of credit, they a lot of times can suffer from a bunch of inquiries. Because when you have inquiries, that's an indication that you're getting ready to go out and put something on credit. And if they see a lot of inquiries, then they're thinking that you might be going on a shopping spree, and it could be an indication that you are stretching your ability to repay. Now, if you have a mortgage inquiry, and I'll say the same thing for auto inquiry, it's not unusual for people to shop. And I mean, hopefully when you call me, you're through shopping, but that's not always the case. But just like when I go look for a car, I not only shop for the right car and the car dealership and the person that's going to give me the best price, I also shop for the best rates. And in that case, there are some times when your credit might be pulled more than once. Well, does that cost you money, or does that cost you points in your credit score? Well, in the mortgage industry and in the automobile industry, the answer is no. What they do is they give you 45 days from the initial credit pull to shop. So I think that's a good thing. So that's enough about inquiries. Payment history. 35% bills paid as agreed. Guess what? If you have a late payment in the last 12 months, there's a good chance you won't get a mortgage loan. And I tell everybody that is applying for a loan that the last 12 months are the most important ones. Now, it says here the most recent 6 months are absolutely the ones that have the biggest effect on scores. So what you don't want to do, and you never want to do this, is you never want to have a derogatory on your credit report. And of course, if you're thinking about buying a house, you want to make sure that within the last 12 months, you haven't had any payments that were missed. The highest weight on the highest pay history, the larger the balance or the creditor, the more weight that it has. So the biggest mortgage or the biggest payment is going to have the biggest effect. And again, if you miss a payment, your score will drop anywhere from 60 to 100 points. And let me tell you, there's not many people that can afford to have their credit drop that much in the blink of an eye. Okay, so here is a really important slide, and this is talking about credit card balances. Keep balances as low as possible. Now, I wanted to stop real quick before I go over this, because this is very important, is if you have any questions, I'm going to answer any of your questions at the end of this presentation. So forgive me if I'm just kind of rocking on. I'm going to finish it. I'll get all the information out, and then if anybody has any questions, I'm going to be here and glad to answer that. Okay? Yes. Yeah. Okay, good. All right, so outstanding balance versus available credit affects your credit score. Now, this is a big deal. And remember I said it's equals 30%. So here's my example. Say you've got 2 Visa cards and you have a $10,000 limit on both of them. But on one of them, it's your favorite card. Maybe you even have a lower rate on this particular card. So you've used the one that you have the lower rate on. And you go on an amazing vacation. And on the vacation, you spend $9,950 on your $10,000 limit. Now, when you get back, because you spent some cash too, you may not want to make a $9,950 payment, so you maybe pay $100 or $1,000 or whatever. But if you look at that, your ratios to balance to limit is over 90%. Now, what happens is that once you go over 50%, they start taking credit points away from you. And as you go up, they take more points away. As you get closer to 50%, like if this were the case where this Visa was at $5,000 instead of $9,950, it would be par. It would be they're not taking any points away, but they're also not going to give you any points. Now, on the other one, this one that's down here, it's a zero balance and they have a $10,000 credit, actually one of the things that's kind of interesting, and this is unique, is everybody thinks if it's a zero balance on an available credit, that's a good thing. Well, I've found that having a zero balance, you do not get any reward whatsoever for having a zero balance on a credit card. And I think it's kind of sinister, to be honest with you, because I think that they're not earning any interest on you for that. And after all the times that we've done credit manipulation, and that's really what it is, it's just playing by their rules, understanding how this game works, we found that the ideal, the maximum benefit that you can get when you're doing your credit is to owe about 10% of the limit or less. It could be less on a $10,000 one. If you owed $1,000, that would be good. If you owed $500, it'd still be good. Okay, but if you owe zero, it's not good. And of course, anything less than 30% is going to be positive. It's all positive when you get below 50%, and then at every point above 50%, it costs you points. So hopefully that makes sense, and you can recognize that on your own specific credit. One of the things that you want to do is you want to find out when the credit card companies report to the credit reporting agencies. And why do you want to know when they report? Because you want to be able to control how much the balance is each month if you're looking to increase your scores. Now, I kind of bypassed a big part of this is why do you want to increase your scores? Yeah, that's exactly right. You want to increase your scores because you get lower interest when you have a higher credit score. If you have a lower credit score, you pay higher interest. So it doesn't take a rocket scientist to figure out that you'd rather pay a lower interest and a lower payment as opposed to a higher payment. So we together want to have for you a lower rate and a higher score. So in this case, I'd said leave credit card balance as is. And in this scenario, what you could do is you could actually balance these out. Now, back when I did this slide, it was in the past. I would do it so that the target was I'd pay some money down and I'd make sure that both of these are below 50%. But actually, both of them being at 50% is going to be better than the way it is right now, because one, you're taking a double penalty. You're getting a penalty for having a zero balance, and you're having a penalty for having 99.50. If you had 47 or 49.75 on both of them, it would be better than this right here. But that's one of the way that you could balance it. And of course, the 10% number is a big factor. Mortgage and installment are less of a factor when it comes to your credit score. So any questions on that? This is a very important slide. Okay, credit history. So if you have a longer credit history, then you're likely to have a higher score. It's just that they've got more information to be able to make a judgment about how you're going to pay. And again, you have to remember what credit scoring is all about is a prediction of whether you're going to go 90 days late or worse. Okay, so they're just looking to see if you're going to be a good payer or a bad payer. A long credit history, paid as agreed, has a very positive impact to your credit score. That's why we tell you to never close credit card accounts, especially if you've got a long history. Because if you close those, it does a couple things. One, obviously, it reduces the history that they can verify. It also reduces the capacity that you have to borrow. So it could have a negative impact to your credit score. Mix of accounts, 10%. It's ideal to have an installment and revolving accounts, a mortgage loan, auto loan, 3 to 5 credit cards. More is okay too, as long as you keep the balances low. Bank cards versus retail cards versus finance accounts doesn't make a lot of difference. There used to be a hierarchy there. For us today in the credit scoring mechanism, I don't think it makes a difference. On HELOCs, they're a little bit of a question. Excuse me, a HELOC is a home equity line of credit. It's usually you get those from the bank. It should be greater than $40,000 or it will report as a revolving account versus a mortgage. Now, I know that's quirky, but that's just the way it works. So here's why that's important. If you borrow $35,000 on a HELOC, and it shows on your credit report as a $35,000 loan against $35,000 or $40,000 limit, and that would be shown as a revolving account. So it basically puts you in a position where you've got a 95% capacity usage instead of it being a mortgage. And a mortgage, it would be graded as an installment, and it wouldn't be as harsh to your score. Now, I also want to just say a lot of this is kind of deep in the weeds, and I want to make sure that you guys know that you can reach out to me, probably not tonight, but the number is 281-348-9899, and I want you to feel free to call me. Let's see if I can actually use one of these tools here. Let's see. So 2, 8, 1, 3, 4, 8, 98, 99. Oh my gosh, that's pretty bad. Looked like a 5-year-old. All right, so we'll go on to the next slide. All right, so history mix. You do not want to have a short history and have a lot of credit cards. It's a double whammy. One, if you have a lot of credit out there, people have given you credit, and then the credit scoring mechanism is a little nervous about you. So the algorithm is tuned so that the short history could be a problem for you. So it's just one of those things that you don't want to do. That's pretty obvious. Now, we're going to look at this credit report. And this is, granted, it's an old credit report, but there's a couple things that I want to show you about it. Is one, obviously the scores are not very good. 544, 512, 478. You can see down here, this particular borrower has tax lien, even though they're released. And of course, I took all the identifying information out of here. At least I hope I did. Let's see. Okay, so here is a mortgage company, and it shows that he's got 6 30-day lates. And obviously, at this particular time, I think that was pretty currently late too. But this other one is, we show right here, it's a credit card. It shows right here that it's a revolving credit card. He's had it for 10 or 7, almost 6 years. And the high limit is $92.38. Okay, so his high limit is $92.38. Now, unfortunately, right now, they've let him go over that because his current balance is $10,907. Now, I'm thinking that with a guy with a 544 or 512 middle score, they're not real happy with him having a $10,000 balance and having $10,000, almost $11,000 lent to him. And of course, what happens when you get in this position, when you go beyond the limit? Well, the interest rates for credit cards usually can jump up into the 20s and 30% range. So this is not a good situation, and it's obviously reflected in this guy's score. He's got a clean car payment here. He's got clean, most of his credit is clean, except for he's got a little bit of dings on his credit card. Notice he's 30 days late, 1 60-day late, and 2 90 days late. They all seem to be right here at the end of 2006. So this was a rough period for this guy, and he's struggling, and his score reflects the same. So now we're going to shift gears, and we're going to look at a guy that's got high 700 FICO scores. And one of the things you're going to see, I think it's going to show what we were talking about. Again, he's got a mortgage also, and it's a low mortgage, and he's got a small balance on it, but he has no lates, right? Then I want to get down to this Sears card. Well, let's see, he's got a couple cards here. In this one, he's got a $4,000 limit, and he's got a $137 balance. Now, that's a very low ratio, and he's not using hardly any of his capacity. He's doing the same thing here. He's got a $7,600 limit with Sears, and he only owes them, I think, $56. And then if you look at the rest of his credit, he just doesn't have a lot of credit. But this is an example of what you want to shoot for, and you can see the results. Now, this is kind of excuse me, this is an exaggerated version, but this is a real example of how credit scores work. So Shopping around will pull multiple reports for mortgage and auto inquiry. Like I said before, you have, after they pull the first credit report from a mortgage entity or an auto entity, they can tell what type of company pulled your credit. And then you have 45 days to shop your heart out. I mean, you can get as many credit reports as you want within that period because it's not going to affect your score. And you can see that each inquiry average of points that are deducted are 2.89. So it's not very much. No, so you might be concerned about this if you're right on the edge, but in most cases, I don't think anybody should be worried about inquiries, and they worry about it a lot. Only the first 10 inquiries each year are counted. So that's another thing. After 10, they won't affect your credit at all. And then young files, thin files, will affect the effect of the inquiries have a bigger impact. And mature files, for people that have had credit over the course of decades, it's going to have a much less effect. So that's my word on inquiries. All right, inquiries that do not hurt the score. There are some that are, guess what? They are what's called a soft pull, and they're job related. Insurance and utilities pull them, and they're not really a hit to your credit. Or an account review. A lot of times the credit cards, when you ask them for a increased line of credit, you can get an account review, and a lot of times those will be soft pulls also. Now, not always. Now, I tried to make this darker, but one of the few places you can actually get a free credit report and actual scores is www.annualcreditreport.com. It's real simple, www.annualcreditreport.com, and you can get a free credit report. Now, I'll also tell you that if you are listening to this webinar and you want to call me at 281-348-9899 and are interested in looking at your credit in an effort to buy a home or get pre-qualified, then guess what? This is another place where you can get your credit pulled for free and get a copy of it. So if you're doing it for fun, or if you're doing it to go buy a mobile home or a vehicle, then I'd rather you not take advantage of me that way. But I would like to help anybody that's looking, and particularly if you've had some credit trauma in the past. Finally, the promotional pre-approval offers in the mail, those are usually ones that don't hurt you either. So hopefully that's helpful. All right, blemish credit can be costly. It's going to lower your credit score. It's going to higher the interest rate. That if you do mortgage loans, guess what? You can see it. It's a big deal because you're going to pay a higher home payment or a rent payment or a loan payment. Same thing on credit cards. If you have bad credit, you're not offered those low 1% and 2% cards that they have out there. And auto loans, oh my gosh, auto loans, I mean, you can get a 1.99 auto loan, or you can get a 27% auto loan. And it just depends on what your credit's like, how you've done that. Even to the point, insurance premiums. If you are shopping for insurance, when you buy a house and you've got lower credit or you've got some kind of trauma there, your premiums will be higher. So there's just a lot of reasons to pay attention to your credit scores. All right, so here's kind of a tier. I don't know if everybody understands how this works, but in the mortgage industry, if you're at 740, you have no risk hits. There's very little risk, and they consider your credit quite good at 740 and above. From 720 to 739, there's a small hit. It's not much. And then there's every 20 points, 700 to 719, you get a little bit of a bigger hit. When you get below 700, it's a bigger hit. And then, of course, the last one, generally the bastion for conventional loans is about 660 to, well, from 660 up. And it's a pretty big hit to your rate. So obviously you want to be above 660 and you want to be above 700 actually. If you go below 660, you're probably going to go with an FHA loan. That's just one of those things, and it's considered a risk factor. The higher the risk to the lender, the more they can charge to offset that risk. It's just like anything. So credit scores are in tiers in the mortgage industry. Steps to take to increase credit scores. Here's where you're going to get. This is kind of like the payoff. If you have past due accounts, that's if they're late, if they've been a month late, or if they're still active, they're not in collections yet, then you want to get those caught up. I mean, that's the most important thing, and it just makes sense. You want to get them caught up. You want to get rid of any late payments, and you want to get back on par with your creditors. And then if possible, you want to have your credit limits increased. Okay, so let's go back on the revolving credit cards. You want to pay down those credit cards that are over 50%. You want to pay them down to no more than 30%. And I would stay between 10 and 30%. Closer to 10 is going to give you a better score. I would not pay any down to 0. And I wouldn't close any credit accounts. Now, one of the little subtle tactics that we use is if you're having trouble getting a credit card, and there is a way to get them, you can become an authorized user. Now, this doesn't necessarily mean that you're going to get access to somebody's credit card, but you can be put on a credit card as an authorized user. And this usually entails you giving your Social Security number to a family member in most cases. Could be a spouse, could be a mom, a dad, a sister, a brother, uncle, if you have a good family group like that. And what they do is they put you on their card so that it reports on your credit. And it is designated as an authorized user's account, but you get some benefit from that. Now, what you don't want to do is you don't want to become an authorized user on somebody's account that doesn't know how to handle their credit. So you have to be a little discerning about asking that, but I see it all the time, particularly with family members. Okay, and for additional information on that, I'm going to encourage you to call me. Again, I don't need to reiterate about not closing accounts. So just going to get a quick sip of drink here. Keep those old accounts active. All right, pay all accounts that are past due. Paid past due accounts can't equal. If it's 1 day late, let me tell you, it's brutal. If you just miss by 1 day, it's going to cost you 70 points, 80 points, maybe more. Can severely hurt your credit score. So be very careful about paying anything late. And you know, even if it's sometimes it's just stuff happens, but let me tell you, you want to beg to see if they'll let you have some grace on that, because it really will hurt your score. Past due accounts do not include judgments and collection accounts. And I always tell people when they have judgments, if you're doing mortgage, and I think I misspelled judgments. I don't think it's judgments. I think that might be, anyway, I don't know if that's right. Anyway, collection accounts, don't pay any of those things until you talk to me. There's some that you don't necessarily have to pay for your score, is what I'm saying. Now, let me tell you, I'm all about you honoring any commitments that you have out there. And I think that's very important to do, but in this context, we're just talking about increasing your score. And there are some things that, and this is part of the not so intuitive part of credit scoring and tactical work, is that paying some things can actually hurt you. It can reactivate old wounds that cause your score to go back down. And here's how it works. I don't think I have a slide for this, but there's let me see if I can go back. Let's see. Yeah, let's go here. There's see this date reported here? There's also on the new credit reports, last active. Here's what I was looking for. It's a date of last activity. So what they want to do is they want to show the date of last active. And what happens is if you've got a collection account and it's been dormant for 3 years, and let's say that you got a $500 balance on there, and you go back and you call those guys to make a payment, all of a sudden it becomes active again. And guess what? It's also still a collection. So it's almost as if you have gone back and woken the sleeping dragon, and all of a sudden your score just gets whacked. So that is a bad idea, and I would always get you not to do that. All right, let's see. One of the things that there are specific things, if it's a newer collection, what we always tell you to do is to phone the creditor and request that the late payments be removed or to work something out with them. Be persistent. You're always going to get to talk with the lesser, newer employees initially, and I always encourage you to work your way up to the supervisors. The supervisors are there. They're a little more experienced. They know that if they can get some money out of you, the better, and they also have more authority to do things. So always request for supervisor if you can. Now, when you pay off these guys, and I don't encourage anybody to do this without having somebody like myself to kind of guide you, but you always have to get a letter that documents the name, address, the account number, the specific late to be removed, how much they're charging you for it. You have to agree to an amount, and it all has to be signed that they're going to accept this payment. Got to be signed by an employee. It should be on company letterhead, because here's what happens. It's not unusual for people to have paid a collection, worked out a deal with a collector, they make the payment, and guess what? The creditor, the collector in this case, does not remove the amount, doesn't show the payment made. And so you call them back and you go, hey, dude, I just made that payment. I need you to change that. Well, there's additional interest. And you're going, wait a minute, that's not what we agreed to. And he goes, we didn't agree to anything. And at that point, you are stuck. And if you think these guys won't do that, you're way off base. These guys are not honorable. If you find an honorable one, it'd be a rare bird, is what I've seen. That's my experience. I hate to be cynical, but I'm just telling you, you have to be really careful, and you really have to dot your I's, cross your T's, get all the verification up front, and make sure that you can track and measure this whole thing. All right, every 6 months, request an increase to your credit limit on your good credit accounts. And now, if you ask for an increase in your credit limit on accounts where you've had lates before, guess what? You're not going to do it. You're not going to get it. So if you have positive accounts, get the credit limit increase. It doesn't hurt anything, and it just makes your credit capacity look better. Have creditor base increase on your previous credit history. Ask them not to pull credit. If they tell you that they're going to have to repull your credit, just tell them you'll pass. You'll keep it the way it is. Okay, but increase your credit limits. Ask a relative or a friend to add you to their credit account. Again, this is the authorized user. It works. You have to confirm the following, though. You want them to give you, you don't want access to their card. You just want to be on their card. But you want to make sure that they're handling it, that their current balance is below 10 to 20% of the limit, and they have a long history and a good payment history. There's no risk, as the credit card does not go to you. It stays in the holder's hands. You just kind of get to ride on their coattails of their good history. So authorized user, that's a big deal. Excuse me. All right, keep all accounts open. I'm kind of saying the same thing over again, but use old accounts periodically, charge small amount, pay them off immediately. A lot of times when we're doing stuff for people that are trying to rally from some kind of credit trauma, I tell them to go and use or get a secure card, and then to go out and either buy gas once a month, and maybe they've gotten a $500 limit on this account, and I tell them to spend $50, and then when they get their bill, I want them to pay $40, leave $10 on there, and then go get gas again, or just use it one time a month so that there's no more than $50 or $60 that ever shows up on there, and they pay their card, they pay that bill immediately when the bill comes out. It's a good strategy, and the longer you do that, the better off you are. And then as you do it multiple times on one card, then you might even consider getting another card. And as your score starts creeping up, when you get up to about 600 FICO score, guess what? People start going, oh, this guy's paying his bills. He's handling this credit like he's supposed to. So those are positive things. And when you get some credit that's paid like it's supposed to be, then that's a good thing. And obviously, third time I say this, closing accounts with long credit history will hurt your credit, so don't do it. All right, consumer to credit reporting agency direct. The credit reporting agency does the research. They verify it. If you have information that you can verify stuff with, they can get this off, but a lot of times they're going to go back to the creditor and tell the creditor to remove it, because what happens is the information goes from you to the creditor, and then the creditor reports it to the credit reporting agency. So in many cases, the contacts furnisher of the credit with any evidence, but it usually comes from the creditor and then to the credit reporting agency. So that's the second part. Consumer direct to furnisher of credit information, that's the way it's normally done. They're the ones that really have the control to determine that. And I can tell you this, there is nothing that says that they can't change the way they've reported on the credit. They will tell you that once it's been reported, they cannot change it. Well, that is absolutely not correct. Consumers, if you dispute something on the credit, if you do that, you want to make sure that you can back it up. You don't want to dispute it just to dispute it. Okay, that used to be a tactic. It's not a good tactic anymore, particularly in the mortgage industry. But after the consumer sends notice of dispute with evidence, then the credit furnisher changes the reporting to the credit reporting agency. So it's just a process. And does it always work? And do they not pay attention to you? Well, sometimes they don't, but you have to stay after them. And that's what credit restoration guys do, is they're notorious for being very consistent and persistent in their efforts to get stuff removed. And there are rules that the credit reporting agency and the creditors have to follow. They have to give you some kind of information within 30 to 45 days. And most, I think it's 30 days. Summary, okay? If you're going to borrow, well, you borrow when you do not need money. They say, you know, the best person to get a loan is the one that really doesn't need it. Keep the balance to the limit low. So keep your balances low. One thing I'm going to tell you is that credit cards are not great emergency funds. What you want to do is you want to save money and put it in an emergency fund. You don't want to, you want to use your credit cards, if you use them at all, as a convenience. And in this particular case, we use credit cards to manipulate our credit score. But like Dave Ramsey says, credit is it's a scary tool, and it's easy. It's a seductress, and it can take you places you don't want to go. And anyway, so I want you to be cautious with those. But I do prescribe using them in a very specific and manageable way. Always, you want to consult with your mortgage professional before you consider paying off any collection or judgment when applying for a mortgage loan. Sometimes you do stuff and it actually hurts you. So I just encourage you to check with me on that. Increasing credit score by 10 points can save you some interest savings of substantial amounts on your mortgage loan over the course of 30 years. So just a little bit of an increase in your score can give you a better rate, and it can make a huge difference. And there's some math that's been done on that. And then finally, if you want to know how your credit scores can affect your life, well, they can cost you less. You can spend more money for retirement, for vacations, for family, for grandkids, all of those things. And we think that those are the things that money should be spent on, not on paying interest to somebody else that you don't know. So that is it for this presentation. That's the end of this particular session. And now I'm going to open it up for some questions. So let me see if I can do this right. To keep your ink annotations, I guess I'm going to say discard those. All right. Now, let me just look and see if there were any questions here. And I apologize for me just rambling on for we've gone on quite a rant today. All right. If you have any questions, if you want to ask them now, you can. I'd love to answer them for you. And I'll just give it a couple minutes. Okay, well, listen, I appreciate it if you came tonight, and I want to make sure that you understand that you can call me working hours. We work on the weekends, and we'd love to hear from you. And so if you have some credit trauma and you're trying to buy a house, which is really a pretty good time to be buying a house right now, then I encourage you to call me. The number is 281-348-9899, and I will see you on the other side. Talk to you next Tuesday. We're going to do another one on next Tuesday about debt. So that's it. Talk to you soon.